So thank you so much, especially the organizers, Jim and Avner, and Mike for this chair of the session. This is joint work with Zhiguo, and this paper today is really about how corporate decisions interact with the financial markets and vice versa, how financial markets interact with corporate decisions. And so here the main corporate decision we're going to look at is default. And so we know from the recent financial crisis that default and liquidity are interconnected, as evident from, say, the spiking default rates and illiquidity rates we saw during the crisis. So here we take a relatively broad view of liquidity. Liquidity here, you can think of funding liquidity. That is, how much money can you raise against a fixed promise of, say, $1 in some years down the road? Then we have price impact, how much can you trade off a certain bond, and how much you're going to influence the price. And finally, transaction costs, say bid-ask spreads and so forth. How much does it cost you to get out of a position? How much are you going to leave on the table with the deal? So really what's prevalent in the theoretical literature is that you usually have one-way linkages. So you assume either a certain kind of exogenous liquidity, and then you look how that exogenous liquidity affects default, or you assume there's a certain default rule, and then you check how does it affect liquidity. Say, when you think of certain run models, they have this structure here. And what today's paper is trying to do is really trying to have liquidity and default interact with each other. So both are endogenously derived. And the challenge of this paper is, in a theoretical sense, that we have to jointly solve for the liquidity and for the default decision of the firm. So everything is jointly determined, which is going to help us essentially have a bit more discipline when we do an empirical investigation of this theory. Because now we have this we have to match both bid-ask spread and the credit spread. So when we try to understand liquidity and default premia, we know, for example, from a report by Barclays Capital, that there's a high correlation between default and liquidity spreads, both in time series and in the cross-section. Of course, they only send us the report, and they didn't give us the data, so we can only really tell you what they give us in the report. Now, there's some recent papers by Dick Nielsen et al. And Freewald and others, where they essentially show that you have this big spike in illiquidity jointly with default during the financial crisis. Okay? But what's usually missing, or not missing, what's usually kind of ignored in the state-of-the-art empirical literature is the interaction between the liquidity component and the default component. So usually what you see in the empirical literature is there's an additive decomposition of the spread into, say, independent liquidity spread and a default premium. And we want to shed more light on how you can interpret these decompositions with our theoretical model. Okay? So what does the data look like? So the motivation here for credit spreads, we essentially have, along the horizontal axis, we have quasi-leverage. That is essentially bonds at face value plus equity at market value. Okay? And so we see that there's a cross-section across rating classes of the credit spreads, as we would assume that rating classes are informative on something. Okay, so that's from Huang. That's one of the dimensions we want to address with this paper. The other dimension is the bid-ask spread, or the liquidity of the bond market. And so here there's a paper by Edwards, Harris, Pivovar, where they actually have proprietary data set from a dealer. And so they essentially bunch certain rating classes into superior, investment grade, and below investment grade. And so they also you see that the bid-ask spread, the illiquidity in the market essentially, it becomes more illiquid the further you move out in the rating classes or the further you move out in the quasi-leverage. Okay? So that's really the empirical dimension we want to address on this paper. Okay, so what's driving the paper? What are the building blocks? The building blocks are essentially just two main building blocks. The first one is to get endogenous liquidity and to have it differ with the state of the firm. We essentially take an over-the-counter search model in the tradition of Duffy, Galliano, Peterson, and then we add essentially the state of the firm. So that's going to complicate the search market, and we're going to show you how we deal with that. And then that's the liquidity. What do we think of the decision of the firm? We just take an endogenous default model, kind of a Leland-Toff model. Now, why do we do Leland-Toft? Because we need rollover in the model. I'm going to explain later why rollover is very important. So the main results that this delivers is that we get essentially a solvable model. We have closed forms for essentially all of the variables that we're interested in: bond values, bid-ask spreads, equity values, and the default boundary. And we can also show that the endogenous liquidity now allows us to match in the calibration the cross-sectional pattern that we just saw. So we roughly match the bid-ask spread cross-sectional pattern and the credit risk cross-sectional pattern. And theoretically, we can show there's a liquidity default spiral, how liquidity interacts with default and vice versa. And it also allows us to have a default liquidity decomposition that's more informed than the kind of assumption that they're independent. Okay, so part of the literature I already mentioned, Duffy, Galliano, Peterson for the search, Leland-Toft for the cattle structure model. There's a paper by Zhiguo with Wei Zhang where they essentially assume an exogenous liquidity. So today we're trying to endogenize everything and trying to incorporate it. So that we get the cross-section of the bid-ask spreads across the rating classes as well. Okay? There's a large empirical literature and many, many more feedback models that I don't want to get into. So here's the schematic kind of view of how this model works. So in the Leland-Toft model, in a very simplified form, outside default, the firm issues a bond for a market price DH. Someone buys it, some investor buys this bond, holds it to maturity. Again, outside default, of course, the bond might default. And after maturity, it goes back to the firm. And the Leland-Toft assumption is that the firm essentially commits to reissuing this bond whenever it matures. So then it reissues. Now, the first element we introduce some liquidity shocks to get trading off the ground. So there is essentially agents that are hit by a liquidity shock with some intensity, and then they have holding costs of holding the bond. So outside, if we don't allow them to retrade, essentially their valuation is going to drop because holding the bond now comes with certain holding costs. Of course, after some time, they're going to mature and the firm reissues. This liquidity shock is already going to affect the value of the debt that they're willing to pay ex ante because they know they might be subject to a liquidity shock. Okay? Now, what we want to do is we want to have a secondary market. So the secondary market we now add via a dealer intermediated over-the-counter market. So the low valuation guys who've been hit by a liquidity shock now with some intensity meet dealers that then intermediate the trade and sell the bond on to better positioned investors that have not been hit by a liquidity shock. And so now the important thing is that the liquidity in the secondary market, because it's essentially an outside option, a way out of the liquidity state, is going to affect the price that you can get for issuing the bond in the primary market. Because of course, everyone is going to take into account that maybe they're hit by a liquidity shock and so forth. So that's really the model in a nutshell. And so now we're just going to go through the different elements and to show you how we can kind of get it tractable. So the preference here, everyone is risk neutral with some interest rate R. And the company has assets in place that pay a cash flow rate delta T. That's basically a geometric Brownian motion. Now there's a debt structure. There's debt in place. Each unit of debt has the same face value P and the same coupon C. And that only, there's a unit mass of bonds outstanding, and they only differ in the time to maturity. And here the main assumption we follow Leland-Toft is that there's a uniform maturity structure. So you think of, if you have a 10-year maximum maturity, that is, they're evenly spread between 0 and 10 years. And every year, 10% of the bonds come due because maturity shrinks as time moves forward. And then you reissue them with the identical contract terms, C, P, and the maximum maturity 10 years. So whenever they mature, you issue them back to the end of this kind of maturity distribution. Now, why is that important? Why do we need this kind of reissuing? Because via the rollover, it's the only way the secondary market and the repricing is going to affect the corporate decision. So here we have a net cash flow of the equity holders. They essentially get the cash flow of the assets in place. They pay a coupon out to the bonds, maybe with some tax benefits. And then each instant, there's some bonds maturing 1 over T. And they're going to issue bonds for a price DH, and I'm going to specify what DH means. It's basically a bond value they get in the primary market. And they have to pay back the face value. And here we allow for certain transaction costs in the primary market. Maybe you leave some money on the table because issuance is expensive. And so now we see that the secondary market conditions are going to matter because via this repricing, secondary market conditions are going to be priced in to the bond value in the primary market. And now, as is usual, there's endogenous default in the Leland-Toft model. You stop paying your bond in default when absorbing further losses is unprofitable. When the option value of keeping the firm alive doesn't warrant paying, accepting maybe a negative net cash flow. Okay, so now let's move to the bond market. The bond market is essentially a bunch of investors, each holding at most one unit of the bond. And each of these guys is subject to an uninsurable IID liquidity shock with some intensity. So you're holding the bond. You can at most hold one unit, or you can hold nothing of the bond. That's a restriction that comes from Duffy, Galliano, and Peterson that makes the model tractable. And so we essentially introduce three types of agents. The L type is a guy who's been hit by a liquidity shock. So he essentially has currently holding costs per unit of time of chi, or after default, we introduce a holding cost chi b times the recovery value here. This thing here is just the recovery value of the bond. Now, how do you get into the L type? There's two guys who can become liquidity shocked. There's an H type, it's a normal institutional investor, say a bond market fund or something like that. So they have a liquidity shock intensity before default of psi, and after default, this liquidity shock intensity goes up. And additionally, they're not allowed to buy any bonds. So you can think of these guys as being banned from holding defaulted bonds. And the psi b here kind of proxying for the probability that they have to sell these bonds once they go into default. Okay? Now there's an S type. We think of specialist hedge fund investors. These guys, before default, have the same liquidity shock intensity as the normal guys, but they also are not in any way affected by default. They can still hold the bond, they can still buy the bond, and they still have the same liquidity shock intensity. Now, we want to, of course, liquidity shock guys, now there's a reason for trade. These liquidity shock guys want to sell the bond, and they want to sell the bond to guys who don't have holding costs yet. And so the intermediation works via an over-the-counter dealer market with some intensity lambda. They meet a dealer, and they bargain over the terms of trade. And so the interdealer market is competitive, and we assume there's no inventory. That's, again, Duffy, Galliano, Peterson. So what that means is when an L type meets the dealer can buy the bond from the liquidity guy, and then immediately turn around and sell the bond on the interdealer market for some transaction price M. And each of these pairs, each of dealer-investor pair, there's going to be some bargaining going on. And the investors have bargaining power better in this bilateral bargaining. Now, the mass flow assumption is probably easier to illustrate via a graph, so we assume the following. We assume that there's a certain stream of sellers that meet dealers. Okay? And here we assume that the stream of buyers of type S, possible buyers of type S that meet dealers, is not enough to kind of absorb all the selling pressure. But we assume that the kind of type H buyers that meet dealers, they are sufficient to absorb all the selling pressure. So that's going to be important in that the H guy here is going to be the marginal agent who's going to price the asset. And it's a seller's market. There's more buyers than sellers. And essentially, we're going to show that surplus only accrues to the sellers. Now, after default, H buyers cannot buy the asset anymore. So after default, there's more sellers than buyers. The S guys are now the marginal agent, but also they are scarce now. So now it's basically only surplus to the buyers. That's basically a buyer's market. So let's move into the actual model. Post default, let's start let's work this model backwards. So after bankruptcy, we assume that there's a payout delay. So we know from the Moody's kind of default and recovery database that it takes about 501 days on average for a bond that goes into default to have an emergence payoff. Okay? So we're going to have some recovery payout at an exponential time due to legal delay. Now, what's that payout going to be? We assume that there's a payout that's basically some alpha less than 1 of the unlevered firm value. So delta B is basically where the firm defaults. That's the cash flow state when the firm defaults. And over R minus mu is basically just the unlevered value of the firm from that point onwards. This is really, we could put something else in here. This is just makes it very tractable and very easy to solve. Now in the post-default market, remember there's only specialist buyers. There's only these hedge funds who buy, but there's not enough of them for the big selling pressure. So what happens is that the seller, the L kind of dealer pair, when they transact, they create a surplus pi L, and the specialist dealer player gets a surplus S. So this is the buying surplus, this is the selling surplus. And because it's a buyer's market, the competitive interdealer price here erodes all surplus that might go to the sellers. So even though the sellers have bargaining power, this kind of competitive interdealer market adjusts the price in such a way that there's actually no surplus to bargain over anymore. All the surplus arises on the buy side, and that accrues to the S types. So the S types are going to get part of that surplus, and the dealers are going to get part of that surplus. And so we can essentially solve for the ask price and the bid price just via the kind of Nash bargaining formula. So the ask price is essentially the kind of low value, the valuation of the low type plus some bit of the surplus, and the sell side, the bid price, is just going to be the valuation of the low type. Now what that gives us, we can solve this kind of post-bankruptcy model quite simply, and we're going to get that the high value and the low value valuations, of course we can also solve for the S type, but that's kind of irrelevant here. You're going to see why. We're going to see that they have effective type-dependent recovery values at the time of default. That comes from this post-secondary market, post-bankruptcy market. Now these, why do we solve for these two values? Because they're going to be boundary conditions for the pre-default market. So in the pre-default market, now what we have that there's an abundance of buyers. And there's a mass flow assumption essentially means that there's enough H-type buyers to buy to soak up the selling pressure. And that means that the H-type is the marginal investor here. There's not enough S-types to soak up all the selling pressure. Now we're going to concentrate on the L dealer surplus pi L and the H dealer surplus pi H. So there's, of course, some surplus pi S that we're going to ignore here. Now the lowest ask price, that is H is buying at, the marginal guy is buying at, and the bid price B are essentially, again, determined by this Nash bargaining game. And so what we have now is that the competitive interdealer price essentially erodes all the surplus that goes to the buy side. There's too many buyers out there, so the interdealer price is going to adjust in such a way that there's no surplus left to the buyers. The sell side now, because it's scarce, is able to extract some surplus, and we get a sell side. The bid price is essentially just the DL, that's the valuation of the low type as if we never were able to sell the bond, plus beta of the surplus. Beta here is the bargaining power of the investor. So here, what that implies is that we can essentially solve for the bid-ask spread as the kind of difference between the high guy valuation and the low guy valuation times some 1 minus beta, that's basically the surplus, the proportion of the surplus that accrues to the dealer. So now the main part is then to solve for DH and DL, these dynamic equations for that. Now, the important thing is that this is basically a valuation bet between H and L investors. It's going to depend, that's going to determine the bid-ask spread, and this bid-ask spread is going to be is also going to be influenced by how close you are to the bankruptcy boundary. Because we saw the bankruptcy boundary had these effective recovery rates. So now, the closer you are to the bankruptcy boundary, there's two effects coming from the bankruptcy boundary. The first is the reversal of the buy and seller market. It's basically a level effect. The bond is worth much less to you because now all the surplus accrues to the specialists that are in that market. Okay, and the high and the low value, the high guys are not the specialists. And now, after default, there's also a higher holding cost that essentially increases the wedge, the kind of valuation wedge between high and low values investors. Okay, so that's pretty much it. We can put all these things together and we can solve the dynamic system. I'm going to spare you the equations. Yeah, 10 minutes? Okay, so we have closed forms essentially for debt, equity, and optimal default. Also closed forms for the bid-ask spread. Now, what we can show is we can show that quasi-leverage is essentially an inverse transform of the cash flow state. So very high cash flow states means very low quasi-leverage, and very low when you are almost at the default boundary, quasi-leverage is almost 1. Okay? So we have some main analytical proposition on the bid-ask spread that I'm not going to go into. Now, why do we translate this into quasi-leverage? Because that's essentially what we have the data on. The empirical work was going to be, there's a measure of quasi-leverage that you have in the data, so we want to translate our model into that. So what happens there's pro-cyclical liquidity in the model. So the closer you are to default, the higher your quasi-leverage, the higher the bid-ask spread in the secondary market. Now, if you think about it, illiquidity increases as the company is closer to default. That also means that for any given delta, if the liquidity in the secondary market worsens, the price for the bond in the primary market is also going to drop because people price in that they're going to leave more value for the bond in that illiquid secondary market. Now what that means is that overall we get this feedback loop. Think about agents are irrational and they think liquidity is constant. So if they think liquidity is constant and the cash flow declines, quasi-leverage increases, suddenly liquidity decreases. And they're surprised by that because they thought it was constant. That value is now declined. That rollover becomes more expensive for every cash flow state. And now equity holders are going to default earlier. They're going to have higher rollover losses. Bankruptcy boundary shifts, suddenly the company is closer to default, which essentially leads to further liquidity decreases that surprise these guys. Now, of course, this is all just a fixed point, really. And the fixed point is the outcome of this spiral, okay? I know Adrian is already smiling. He doesn't like that I explain fixed points as spirals, but I think it's good for the intuition how they interact. Now, let's come to the calibration. So in the calibration, we take roughly pretty standard parameters on the firm side. So we have a volatility of 25%. The drift here is under Q, 0%. You can easily get that from certain assumptions on the P measure drift. Tax shields and principal of 1, we have a coupon of 3.9%, gives us that the bonds are issued at par at 190 basis points credit spread. And initial cash flow we pick in such a way that we essentially have these bonds issued at par. Now, on the secondary market, we have a 2% interest rate. Now, the important thing here is the holding costs. And the holding costs, actually, Zhiguo and me were not really certain what we should put in the holding costs. Because holding costs could be either fixed, that is, we keep the face value fixed here. That could be chi 0. They're constant across different bonds. But we think that if you have a very low-rated bond, you usually have, if they're issued at par, a very high coupon. So if you have a fixed holding cost, essentially being in a liquidity state is not as bad for a BBB bond than a AAA bond, and we found that rather counterintuitive. So we put some holding costs that are proportional to the coupon C. So when you think that these bonds are issued at par, and you get to lower and lower ratings, essentially the coupon has to increase, and then the holding costs increase with that. And we have the recovery values we get from essentially an empirical investigation of the default and recovery database from the recovery after default. So with that little model we built, we just take to the data, and it gives us 53 and 50%. Now, what does this look like? The calibration here, this is the liquidity that I showed you at the beginning, Edward Harris Pivovar, of the different rating classes. And our model does the following. The solid line here is essentially for every level of quasi-leverage, we readjust the coupon to have the bond issued at par at each level of the quasi-leverage. Now, of course, as we adjust the coupon, we also increase the holding cost. So you might not be happy with that. So the dashed line here is essentially keeping C constant, not readjusting the coupon to have it issued at par. So this bond is only issued at par at a quasi-leverage of 40%. Other than that, the coupon is fixed, so the bond is not issued at par anymore outside the 40%. But it roughly matches the kind of cross-sectional increase in the liquidity that we see in the market. Now, second, we have this credit spread. And the credit spread, our model performs also reasonably well. And here, the difference between the dashed and the solid line is not so big. The one thing our model gives us, because the search market doesn't vanish, it gives us a spread at AAA as well. Because the search market still has some illiquidity frictions that don't disappear. And it does reasonably well also for the very low-rated bonds. Now, as a last thing before I conclude, is I want to talk about the decomposition. So in the empirical literature, for example, in the Longstaff paper, in 2005, they take CDS kind of prices and back out the kind of default component, saying that CDS markets are very liquid, so they are basically an unambiguous measure of kind of the default component of the yield. Now, well, the question, we want to take this a bit further, and the question we want to ask is, how much of the default component is actually caused by liquidity? Because our model tells us that these two things are not independent. So if you take the yield that we observe, this yield in the traditional kind of empirical literature is going to be decomposed in a default component that you get from that CDS market, and then a liquidity component that's essentially the rest that's left over. Now, we can kind of split up this default component into a pure default. That is, suppose the secondary market were completely liquid. We're in a Leland-Toft world, and we take the optimal default boundary of the Leland-Toft world. That's essentially pure default. There's no liquidity interaction. The second thing is we still take the secondary market to be perfectly liquid, but we impose the kind of default boundary that our model gives us that, of course, comes from liquidity interactions. So that's basically liquidity-driven default. Still no liquidity going on, just the default boundary has shifted because of liquidity. And the liquidity component we can similarly decompose. There's a pure liquidity effect. Think of the Duffy, Gallia, and Peterson paper. There's no default in that paper, so it's a riskless bond, and so you have some steady state kind of friction that comes from that search market. That's the pure liquidity effect. And then there's the additional effect that usually, because the post-default market is more illiquid, the closer you are to default, the more illiquidity you're going to load up on. Because you're going to, in expectation, there's some illiquidity that's driven by the closeness to default. So that's the kind of default-driven liquidity. And so now, essentially, we have this decomposition that allows us to essentially have a better understanding how liquidity and default interact in the empirical world. Now, in an ongoing work with Wei Chen and Roy Q from Chicago and also Zhiguo, we're applying this model incorporating macroeconomic states. So across the business cycle, trying to tease out what the decomposition to highlight this liquidity default interaction. So when you get into crisis, how much of this decomposition is shifting between, say, liquidity-driven default and default-driven liquidity. Okay? So that's pretty much, I should wrap up, so let me skip the last slide. So essentially what we presented today is fully solved model, where we jointly solve for liquidity and default boundaries. So we get closed-form solutions for debt, equity, default boundary, and the challenge here was to jointly solve these things. I showed you the liquidity default spiral. Lower liquidity in the secondary market lowers the distance to default, which lowers liquidity in the secondary market, and so forth. Now, of course, what about adverse selection, you might ask? There's actually a paper by our discussant, Carrie Bach, that kind of tries to solve some of these things in a dynamic, in a kind of Kyle-style model. We think it's definitely reasoning, but we found it very challenging. And to the best of our understanding, it's probably going to generate similar empirical liquidity patterns. But since our model, for understanding the role of liquidity, we saw that the search framework kind of delivered first-order effects while still being tractable. So that's essentially why we went that route. The empirical implementation, we showed that you could targeting liquidity, we matched the bond credit spreads, and then we're able to decompose into liquidity and default component in a kind of more informed way than just assuming that they're independent. So that's pretty much the paper, and yeah, thank you.